Hi there. So let's continue with our next lesson. That is the third lesson in investment appraisal, and we are looking at the methods. In the previous lessons, the first lesson, we considered the various overviews of the things that we need to consider, and then in this lesson, what we want to look at is to consider our next method, and we will look at the ARR in the last method, in the just ended lesson. So when it comes to the payback period, what is the payback period like? Now the payback period simply tries to answer the question, how long or how quickly or how soon will the organization be able to recover the initial investments? In other words, if we should put, let's say, $200,000 into the business, how long will it take for the business or for the project to be able to pay off that $200,000? That is what we want to consider in relation to the payback period. So we're going to be looking at the same question that we are using, and also to calculate the payback period for the two projects that we have before us. So project 1 and then project 2. So let's go to project 1. So project 1. Now so the schedule we're going to be using here is that we're going to have time, we're going to have cash flow, and we're going to have cumulative cash flow. So these are the three schedules that we're going to have, and then we decide to work in 3 zeros up in pounds. So with the project 1, 0 is always the now, the initial investment, and we are told the initial investment is 556. So cumulatively, it's going to be 556. Then we are told that every year we are going to be getting how much is it? Yeah, $200,000. So year 1, $200,000. Now remember, we are asking how long will it take for the company for the company to recover the initial investment. So for any amount of money that comes in as an addition or any returns that come, we're going to subtract it from the initial investment up to where the initial investment becomes positive. Then we will now calculate our payback period. So if we subtract it out, that is going to give us 356, still negative. We've not done it. When we come to year 2, still 200,000, we subtract, we're going to get 156. It is still negative. Then we will come to year 3, 200. Now remember that if year 3 comes in, now the cash flow will become a positive of 44 pounds. Now, so you see that the payback period is between year 2 and year 3. Now, the fact that it was the third year that the cumulative cash flow became positive does not mean that the payback period is 3 years. So the payback period is between 2 years and 3 years. So to be able to calculate a payback period, we will say that it is from the second year, so that is going to be 2 years plus. This is very important in relation to estimating our payback period. We are going to ask ourselves how much was left before the cash flow came in, and it was 156 divided by how much cash flow came in for that period for it to go to positive, and it was 200, and then we multiply it by 1 year. So looking at how we can be able to determine the cash flows of the company, we're going to, the payback period of the company is going to be 2 years plus this one. And so when we do that arithmetic, it's going to give us 2.78 years. That means that, so as I mentioned to you earlier, the payback period is between year 2 and then year 3. So this is how long it takes. Now, Assuming this it was just a single project, then we will compare this payback period against the company's required payback period. So maybe the company can say that any project that exceeds 3 years, we will not undertake that project. In that case, since this payback period is less than 3 years, then we can undertake the project. But if the payback period is more than the 3 years, as we have said as a company, then we are not going to undertake the project. But remember, as always, that payback period can also be used to compare between two mutually exclusive projects. So in this question, there are two projects, and the examiner is asking us to determine which of the projects the company will be able to achieve or can undertake in relation to that. So that's the first project. So let's look at what happens in the second project. So in the second project, the same preamble we're going to be using. Let me do this project 2. Spice this up. So project 2. Now in looking at project 2, we have to still go by the same rule. The initial cost 1616, 1616, and we are told that every year 500,000 comes in as what? The returns. Receipt less payment. So 500,000. This will reduce this to 116 like this. Am I right about that? Yes. Year 2, 500 will come in and it will reduce it to 616. Still negative. Year 3, 500 will come in and it will reduce it to 116. Still negative. Then year 4, it's going to be still 500. But this time around, it's going to go to a positive of 384. So you see that the payback period for this project also is going to be between what? Year 3 and then year 4. So now we calculate the payback period to be as, the payback period to be as 3 years, right? Plus how much was left before the cash flow came in to make it positive, 116 over the cash flow that came in 500 times 1 year. So we look at how much cash flow was having negative there cumulatively. Then we look at a cash flow that came in before to make it become positive on the next line, and that is going to give us 3.232 years. So if we compare, this is 3.32 years, and the project 1 was 2.78 years. So in that circumstance, since the project 1 has a lower payback period than the project 2, we say that the company should accept or undertake the project 1. So this is how the payback period is done. Very, very simple, straightforward in that case. But the key aspect is that you should be able to know how to calculate this payback period, as it is how much money was left before the positive, and then how much cash flow came in to turn the negative into positive times 1 year. Then you add it to whatever year that last negative was, and that gives you the payback period. So that is how the payback period is calculated in that case. But the payback period method or approach has a limitation. The payback period approach has a limitation. What limitation does it have? The limitation the payback period has is that, one, it doesn't take into consideration time value of money. So that is a limitation. So the payback period, as we see here, there is nothing like time value of money. It is just asking how much money will be coming in and how long will it take us to be able to make the returns. So it is not taking into consideration time value of money. Two, the second thing also is that the payback period does not take into consideration cash flows that the company earns after the payback period. So for instance, if we look at it in the first project, project 1, we will look at it that it was 2.78 years. Now, 2.78 years means that is how long it takes for us to now pay off our initial investment. But the question is, what is the returns after the payment of our initial investment? It could be that after the initial investment, something can collapse. So it doesn't take into consideration any cash flows that result after the payback period. Then another limitation we can also talk about in relation to the payback period is that it does not incorporate taxation or issues about taxation and issues about capital allowance, right? Because if you look at the question we calculated here, we're just talking about inflows. But you know that, or you have to know that every project that a company undertakes, there will be a tax effect on the returns that is coming in. So actually, this returns coming in, the company will be paying some tax on the returns. So the payback period we're actually calculating may not be the right payback period after we take the tax out. Then also, because it is an investment project, capital allowance will be received. So you're going to be paying tax and you're going to be receiving some capital allowance. So technically the tax that you're going to be paying is going to reduce. So the payback period does not also take into consideration all these issues in relation to that. Then also, we can say that the payback period does not take into consideration changes in the variables that affect the income that is the company makes. Because if we look at it here, we are just looking at receipts less payment, that's all. But what if the receipts, what happens if, for instance, we expect that we should receive 500,000 in the third year? What happens, or what is the certainty that this 500,000 will actually be received every year? What is the certainty? Maybe we have made a sales budget and we know that every year we're going to make that sales of 500,000. What if the market doesn't do well, or what if the market does better than what we have estimated? So the changes or the effect of the changes in variables, which is about sensitivity analysis, is not incorporated into the payback period. So all these are some of the limitations that we can discuss when we talk about the payback period. Now, due to the limitation of the fact that the payback period does not take into consideration time value of money, a modified method has been prepared so that at least it could take effect of the time value of money. And that is what is referred to as the discounted payback period. So let's look at the discounted payback period. Now, so the discounted payback period, as the name discounted suggests, simply means that the company now it's looking at how long it's going to take to be able to pay the initial investments, taking into consideration time value of money. So if we're expecting that every year we're going to have 500,000, we're going to discount that into today's currency. We're going to discount that into present value, because remember, the initial investment we are putting into the project is today's money and not tomorrow's money. So since we are putting in the project in today's currency, we're going to also discount the future cash flows into present values. Then we're going to take that time value of money into consideration and ask ourselves, how long is that going to take for the company to be able to pay for the initial investment from the returns that it earns from the investment. So looking at using the same question as our guinea pig, we're going to look at the discounted payback period, and I've not presented that in your handouts, but I'll be going through that on the board and you can take notes of that. So using the discounted payback period, we're going to do for project 1. Now, with the discounted payback period, the schedule is going to be slightly different from the schedule for the traditional payback period, because of the fact that we're going to be bringing in the discount factor and then the present value. So let's look at how we're going to put the schedule down. So we're going to say time, we're going to put cash flows here, Then we put a discount factor here. Now, what kind of discount factor are we going to use here? We're going to use the company's cost of capital. Now, in this question, we've been given the company's cost of capital as 15%. So that 15% is what we are going to be using to discount the cash flows. So discounted factor at 15%. Then we're going to find the present value. Then we will now find cumulative present value of cash flows. Right. So that's it. So still we're going to be working in thousands up, thousands up, thousands up. So project 1, the initial cost is still 556. Remember, year 0, the discount factor is always 1. Okay? So that the same figure will come here as 556. Then cumulatively, it will be here at 556. Then we are told that on the project 1, every year the company is going to be receiving a returns, net payment of $200,000. So year 1, $200,000. Then we bring the discount factor of 15%, and we are going to read that on the present value table. Now when we read that on the present value table, year 1, 15%, that is 0.870. So we multiply it, and that gives us 174. Now that 174 is a positive, so it's going to reduce this to 384, still negative. That will be a following, still negative. Then year 2, still we're going to receive 200,000, but the discount factor here will be 0.756. When we multiply, we're going to get 151.2. Now that will reduce this negative to become 230.8. We come to year 3. The same 200,000 is coming in. The discount factor will be 0.658. And that will give us, when we multiply, will give us 131.6. When we strike it out, that is going to be negative 99.2. Then we come to year 4. The same 200 is coming out. Present value is 0.572. When we multiply, we get 114.4. That leads us to a positive of 15.2. So we realize that the payback period is between what? The 3rd year and then the 4th year. So we will now say discounted payback period. So our discounted payback period will now be equal to the 3 years that we were at plus how much was left, 99.2 over how much came in, 114.4 times 1 year. Okay, times 1 year. And so when we strike it out, we are going to get 3.87 years. So you see that when we were using the payback period, we got 2.78. But when we are using the present discounted payback, we are now getting 3.87 because right now we are taking into consideration time value of money. So you could see that the project is taking longer time to actually derive what? The income, which is actually what we are supposed to do, taking into consideration the time value of money. So this method is more accurate than the traditional payback period because we are taking into consideration the time value of money. So in relation to project 1, taking into consideration the time value of money and calculating the discounted payback period, this is how we go about it. Very, very simple, right? So let's look at the project 2 also, and then let's see what the project 2 holds for us. Let's see what the project 2 holds for us. So I'm going to keep that same schedule. I'm going to now name that as project 2. Now project 2 costs 1616. Discount factor will be 1. Present value will still be 1616. Cumulatively 1616. we are told that project 2 is going to receive a returns net payment of how much? 500,000 every year. So year 1, 500,000 is coming in. Discounted factor 0.870, shouldn't have cleaned that, and that will be 435. We look at it and that will reduce to 1181, still negative. Year 2, we're going to be receiving 500,000. Discount factor is 0.756. When we multiply, we will get 378, and that will reduce it to 803, still negative. Year 3 is going to be still 500,000. Discount factor 0.658. When we multiply, that will give us 329, and it will reduce this to 474, still negative. Year 4, we receive 500, and then that is 0.572. Remember, the project has a lifespan of how many years? 5 years. The project has a lifespan of 5 years. So when we multiply it, that will be 285, and that will lead us to a negative of 188, still negative. And then the fifth year, we're going to receive 500, and that will be 0.495. When we multiply, we'll get 247.5. When we subtract, that will lead us to a positive of 59.5. So it means that for the project 2, the payback period is actually between the 4th year and then the 5th year. So technically, this project is giving us a net present value of only 59,500 pounds, right? 59,500 pounds. So discounted payback. So discounted payback period. It's going to be the 4 years where we were at, plus how much was left, 188 over how much came in, 247.5 times 1 year, and that gives us 4.48 years. So again, you realize that taking into consideration the time value of money, payback period is going further close to the end of the project, right? Close to the end of the project. Now, so looking at the payback periods that we have for the 2 projects, you realize that project 1 is lower than what? Project 2. Because project 1 is 3.87 years, and then project 2 is 4.48 years. It means that project 1 is going to take less time when we take into consideration time value of money to be able to pay for the returns. So since the 2 projects are mutually exclusive projects, which means we can undertake any of the projects without the dependence on other projects, we can what? We have to accept and implement the first project. So this is what discounted payback period is all about, where we are taking into consideration the time value of money to be able to calculate the, to be able to determine or ascertain whether a project should be accepted or a project should not be accepted. So that is what you must understand about the discounted payback period. What I want you to be able to distinguish between the payback period and then the discounted payback period is the schedule that we are putting across. So the time period, the cash flows, the discounted factor, the present value, and then the cumulated present value of cash flows. Remember, the discount rate you are going to be using here is the company's cost of capital. If they don't give us the cost of capital, then certainly we can't use the discounted payback period, because this is not like internal rate of return when we have to do try and error as we were doing when we were calculating the cost of capital. Here, we have to be straight to the point and look at the company's cost of capital and use that to be able to discount the cash flows and decide which project should be undertaken and which project is not to be undertaken. So that's it about that, and that is what payback period is. So we've discussed the accounting rate of return, and we've discussed the payback period, and then the brother of the payback period, literally the discounted payback period. So let's look at the fourth one. The fourth one, which is the net present value. Now, fundamentally, this is going to be the fundamental method, or this is going to be the major method that we're going to be using in relation to the appraisal of investment decisions. Especially in advanced financial management, the examiner is not likely to be coming from the methods that we have done so far, but will be coming from the net present value. And not necessarily coming from the usual net present value, but will come from the advanced net present value where the company is making international investments. Nonetheless, you need the foundations to be able to understand how those decisions have to be made. Now, so when we talk about the net present value approach, it is only when we appraise the project taking into consideration all other factors. So under the net present value approach, the decision rule is that when the NPV of the project is positive, we accept the project. When the NPV of the project is negative, we reject the project. Now, when the NPV of the project is positive, it means that it is going to increase or maximize the wealth of the shareholders. But if the NPV of the project is negative, it means that it is going to reduce the wealth of the shareholders and minimize the wealth of the shareholders. So that is what you have to understand when we talk about the present value method. Now let's do some introductory discussions here, and then in the next lesson or in the next video we will discuss what we have to do in relation to the method of net present value. Now there are three formulas you have to understand when it comes to net present value. Now we have what we call single cash flows, which are going to be discounted at the present value. Then we have the annuity cash flows. And then we have what we call the perpetuity cash flows. Now the single cash flow is where there is a different amount of cash flow coming in during the life of the project. So for instance, let's say the project has a life of 5 years. In year 1, the inflows was 200, year 2 the inflows is 300, year 3 the inflows is 500. So if the flows are different like that, then we're going to be using what? The single cash flow approach, where we're going to be discounting the cash flows at what? The present value. So if you look at your NPV table closely, you realize that there are two things here. We have the present value, and then we have the annuity table. Now, so usually we're going to be using the present value table. But if the same amount of money is received over the life of the project, so the project has a life of 5 years and we are receiving 200 Ghana cedis over the 5 years, then we're going to be discounting that using what? The annuity factor. So there we're going to be reading that on the annuity table. Now when you pick those tables, they are there. Now there is a third table called the normal distribution table, and that one will be used in advanced financial management when we are taking into consideration the issue about options, that option theory in investment appraisal. So there are actually three tables that you have to note about: the present value table, and then the annuity table, and then the normal distribution table. But there is also another one that is called the perpetuity. Perpetuity is where we're going to be receiving the same amount of money into eternity. So for instance, a company can tell you that if you're able to save 100 Ghana cedis every year for 5 years, from the 6th year, or when you die, we're going to be paying, or we're going to be giving your family 50 Ghana cedis into eternity till the business collapses or something like that. In that case, you are receiving the same amount of money in perpetuity. So with that one, the discount factor is going to be 1 over I. 1 over I, simple. So when we want to find a discount factor, so if for instance, we are receiving 500 Ghana cedis in perpetuity and we are finding present value of that 500 Ghana cedis, it's just going to be that 500 Ghana cedis times what? 1 over the required rate of return of the company, and then we are going to what? Get the present value of the cash flows in relation to that. So these are the three things you have to understand starting out about NPV. That when there is a single cash flow, we go for the present value table. When there is an annuity, the same amount of money is being received over the life of the project, we go for the annuity table. But when the same amount of money is received into eternity, in perpetuity, we're going to be going for the perpetuity as a discount factor in relation to that. Then there are some key principles that we have to understand, and I think I've gone through these with you previously, but let's just emphasize on them again here. The first thing is that we are interested in present values. We are interested in cash flows and not non-cash flow items. So we are interested in money payments and money receiving, and we are not interested in anything like depreciation, provisions, amortization, all those guys, non-cash flow items. We are not interested in them in this place. The second thing also is that we are interested in future cash flows or incremental cash flows or opportunity costs. That is also something that you don't want to forget. That is what we are interested in as a company. Any sunk cost, we are not interested in. Any committed cost, we are not interested in. Any historical cost, we are not interested in. It is about the additional cost or the extra cost that we are going to be incurring by investing in that project or undertaking that project or accepting the decision. The third thing is that there is always going to be some amount of inflation in the question, in practice, because normally inflation is going to happen year after year. So you can't say that you'll be spending the same money over the life of the project. So inflation is going to be coming in. Now, when there is inflation, the actual cash flows should be discounted at the actual cost of capital, right? Or the money or the nominal rate, and then note, alternatively, it is possible to discount the cash flow ignoring inflation at the cost of capital. Ignoring inflation is where we talk about the real rate. So there are two things you have to understand here. You have what we call the nominal rate and then the real rate. Now, nominal rate is where we are taking into consideration inflation in the cash flows. So if there are inflation in the cash flows, then we want to use what? The money rate or the nominal rate. But if there is inflation in the cash flows and then the cash flow are in current terms, then we can use what we call the real rate as well. Now, I'll be explaining this to you later on as we move ahead. But it's important to note that when there is inflation in the question, you have to discount it or use what we call the nominal rate to discount the project. Now, this is where the issue in relation to what we call the Fisher formula comes in, and we'll be discussing that also in a moment. Another thing here is about taxation. Remember I told you about taxation when we were discussing about the disadvantages or limitations of the payback period. Now, taxation is going to come on board, and we are going to calculate the tax that we are going to be earning on the net cash flows of the investments. But along with the tax, there is also going to be capital allowances. So once we are investing in an asset, once we are undertaking a project, there is going to be capital allowance that we are going to be receiving on a project. And we will be solving a question also in relation to how all these can be incorporated in one question. And then the last thing is about working capital. Now, there are some projects that when undertaken, you don't just spend the money at the start of the project, but in the maintenance of the project, you're going to be spending some money. That is what we refer to as what? Working capital requirements. Now, it is necessary for the project. So these are cash flows in your schedule, but they have no tax effect, and unless told otherwise, you assume that the total cash paid out is received back at the end of the project. So usually working capital are not included in tax. So in our MPV schedule, what is going to happen is that we're going to bring sales, we're going to bring variable costs, then we're going to bring contribution, then we're going to less fixed costs, then we're going to get net sales, okay, or sorry, net profit or net cash flows. That net cash flows, we're going to charge tax on that net cash flows. Then after that, we bring our capital allowance. After that, we bring our working capital. Now, one thing you must understand about working capital is that it is an assumption that any working capital that is released during the start of the project or within the project, that working capital that we are paying during the project will come in as a cash inflow at the end of the project. So if at the start of the project or in the second year of the project, we injected a working capital of 200 Ghana cedis, that is a cash outflow. But at the end of the project, which is, let's say the project has a lifespan of 4 years, at the end of the project, this 200 Ghana cedis, which was an outflow in the second year, will become an inflow in the fourth year. That is what you have to understand. Unless the examiner tells you otherwise, this is a very key aspect you need to understand. Then the final thing you must understand is that when it comes to taxation, there are words that the examiner can use. The examiner can say tax is paid 1 year in arrears, or tax is paid in the same year that the tax revenue or income is derived. Now, when tax is paid 1 year in arrears, if the project has a lifespan of 4 years, you're going to do the schedule for 5 years. Why do you do for 5 years? Because the tax for year 1 goes to year 2, the one for year 2 go to year 3, the one for 3 go to 4, and the one for 4 go to the 5th period. But if the tax is payable in the year as and when current or money is received, then if it is 4 years, we're still going to do the schedule for the 4th year. We are going to answer all these things and explain all these things in the question that we are about to be solving in the next video. So these are what I refer to as the basic principles that must guide you in relation to preparing the net present value of the project, taking into consideration a lot of factors in that case. So I'll see you in the next lesson or in the next video where we look at the questions that we can solve in relation to calculating the NPV and possibly also look at the internal rate of return.